Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. Large cap equities are back in favor, it seems. Bank of America published its fund manager survey for August, and it showed that institutions are moving back into U.S. stocks. Money managers surveyed by the bank are less bearish than they were a month ago, with only 26% now saying that their outlook on stocks was negative versus the 44% recorded in July's survey. Asset allocations to U.S. and technology rose by 15% this month, and the fund managers now have an average 10% overweight in U.S. stocks. Given that the participants in the survey manage more than $700 billion, that's quite meaningful. We can see the improvement in sentiment towards large-cap U.S. stocks in this week's ETF flows data. The top three performers in terms of inflows are all U.S. equity trackers, with almost $7 billion flowing into ETFs that track the S&P 500, which is up by 11.44% over the last month and by 4.43% in the last week. The fund managers also like growth stocks, and for the first time in 2 years, the majority of survey participants believed that growth will produce better returns in the next 12 months than value. It's no surprise, then, that the SPDR Portfolio S&P 500 Growth ETF sits third in the weekly inflows table, picking up just over $1 billion in new investment last week. The ETF with the ticker ACWI tracks the MSCI All-Cap Weighted Index, which in effect is a basket of global equities. What's notable here is that over the last month, the price of ACWI has posted 17 new highs and has risen by just over 10%. That's impressive given that the fund tracks 85% of the market cap of both developed and emerging market equities, which can often be moving in different directions. The very fact that these disparate markets seem to be pulling together is another vote of confidence for stocks. We also note that the recent uptick in ACWI coincides with a downturn in the VIX index, which visualizes the level of fear and greed among S&P 500 investors, and judging this measure, greed now appears to have the upper hand once more. That's a view that's supported by the performance of both TAIL, the Cambria Tail Risk ETF, which is down by 5.9% in the last week, and BTAL, the U.S. anti-beta market neutral ETF, which has lost 11.76% over the last 5 days. BTAL's price has also posted 12 new lows over the last month. Both of these funds, which we have featured several times this year, are designed to do well when markets are fearful and to protect investors in risk-off scenarios, but that isn't where market sentiment is right now.